All right, guys, to the investment pros, because it has been nuts. So we brought in for the first time Kurt Cambier, Centennial Capital Partners senior partner. Kurt, you ready for help us to figure it all out?
I'm ready.
All right. Of course, where are you from?
Denver, Colorado.
And, and everyone, we already asked about the weed, folks. He didn't bring it. Hillary Kramer, CIO and president of A&G Capital, is with us again. Hey, Jim Frischling, president of NewOak Capital. They're all smiling because they all made money today. Heather Herzog, she's smiling too. So we're feeling a lot better than we have in the last decade, Jim. But remember, the stock market, we're at all-time highs. So still some tough going getting everyone to sort of buy into this.
I think we have a happy consumer and we have some worried economists. You asked me a couple days ago whether the fall in oil was good for the consumer or bad for the stock market. And the fact is, I think it's proven to be a little bit weighing heavy on stocks. I think the number of jobs it's costing us, the number of sectors, other industries are being weighed down now by the collapse of oil. And I think we really are at the mercy right now of OPEC and specifically the Saudis. So, and to Matt's point about the financials, banks operating as banks, positive. Banks operating as hedge funds, not so good. That's why Goldman got hit. I didn't get a chance.
I wanted to sort of carve out a segment today. Maybe we'll do it next week. But it seems like these community banks, SunTrust, Comerica, it looks like their loans were up and that they're doing better. Maybe it's just that these guys under the scope of the Dodd-Frank kind of regulation, the big names keep getting hit pretty big. What do you think, Jim?
I agree with Kurt that oil is not going to stay at these levels, but I also feel we're not done yet with this story. And to that effect, I do think there is some contagion. And again, a little worried about
when you say contagion, you mean it's not just an oil story. Well, I mean, obviously, copper's down, palladium.
Yes.
There are other commodities that have gotten hit, too. That's hard to sort of brush off.
Correct. And when we look at, core, I think it's not just an energy story. I think in Texas, right now, the housing, hotels, some restaurants, but when you talk about sectors to actually supermarket. You talk about Whole Foods, but even other markets. I think people have a few extra dollars in their pocket and they're willing to go spend in a market. But I agree with Heath. I wouldn't go out buying fancy dresses right now, but I think the supermarkets are doing okay.
But who would believe this, that investors, or at least Wall Street, will be rooting for higher consumer prices? I know it sounds counterintuitive, and you'll tweet me and say that we're evil, greedy people, but the lack of deflation and core reading actually saved the day, and there's a reason for that. If anybody would read the history of the Great Depression, and other big-time collapses in the economy, Jim, the viewer would know that there is a point when this stuff is free-falling. It's not going to be pretty at the end.
No, that's absolutely right. And I think the investors started to buy momentum in equities when they realized the deflationary environment wasn't as bad. In fact, we're pretty benign in two things. What's the Fed trying to do? Manage the inflation environment and jobs. So if the inflation right now is benign, the Fed actually can, to a certain extent, stay the course. They're not in a rush to raise rates. As I said, we're going to raise rates this year, but it's going to be done in a fairly accommodating manner.
You're still banking on this year, huh?
At the end of this year, but still a very accommodating backdrop for rates, which I think creates a very good environment still for equities. So there you have it.
All right. So what do you think, Jim?
What I heard you say up there was owning great companies. I heard you say not trading but investing for the long term, not selling great companies just because there's a slight pullback of sort. So again, I'm thinking about in my portfolio, what companies do I like, and has anything changed in my thesis? Also, the trends. Utilities, for example, had a great run. One of the reasons I thought they had a great run was because it was almost an alternative to the fixed income markets for their high dividend. If you think rates are going to rise quickly, the utilities are probably not a great idea for you. If you believe that rates, like I do,
but your core holdings though has more to do with the company themselves and the ultimate potential.
Company first, and then they got a little bit dividend focus right now.
$17 trillion in debt, and now we hit the $18 trillion mark, and there's nothing. It's just crickets. No one's even saying anything anymore. We just forgot about that.
Well, when it comes to debt, I like to say when you lend someone a little bit of money, you control them. When you lend someone a lot of money, they control you. The world doesn't let the United States an obscene amount of money, but we are still the safest game in town. Our currency is a backstop. We have the strongest military. But to answer your question, this is not sustainable. And I think, if anything, we need to use the little uptick we've just had and quickly start reining some things in, whether it's tax reform, whether it's dealing with some of the benefit programs we have. But the fact is, this is not sustainable long term.
In September 2012, President Obama green-lighted this fast track, and everyone's been fighting since to make sure the construction is in their county. It's crazy. It's ridiculous.
I'm not going to defend the high-speed rail rail. But we do have an infrastructure issue. Our bridges are collapsing. Our roads are collapsing.
So why are we building an entirely new infrastructure in a place where everyone likes to drive cars?
Because everyone's doing the NIMBY thing, not in my backyard. No one wants that project in their backyard. No one wants a 2nd Avenue subway if you live on 2nd Avenue. But meanwhile, 20 years from now, that may prove to be a reasonable project and a valuable project for the city of Manhattan.
They say it's going to be done by 2029, and a ticket will cost you like $100. I don't know that math adds up, because I know there's going to be an extra few billion tacked on for this, another few billion tacked on, because we don't want to mess up the mating habitat of the certain salamander right there and all that kind of stuff, Kurt.
I continue to like Whole Foods, and I said earlier in the show, the supermarkets, I think that's one area where the consumer is going to start spending more money. Whole Foods, premium, organic. There is some fierce competition, but they're doing really well.
Kurt, Jim, last but not least, Tanger. This is amazing, because we're getting a lot of tweets on these real estate investment trusts. It's been rocking. You've been rocking and rolling with this thing. When interest rates go up, though, is that good or bad for real estate investment trusts?
That's going to be a problem for the REITs. I still think they have a fortress balance sheet. I do believe they're the only pure play outlet out there. And again, they offer a service or a platform for retailers that I still think is differentiated. So I still like it.
The discount model, yes. People outside that thing.
And they have brand value.
They really do. They call it Tanger in the New York area, though. They did it because, that's an indictment more on the European economy and actions coming up. But you're worried, too, about this.
I think I agree with Hillary, and I think this story is not yet done. The auditors and the regulators not figured out who's undercapitalized so quickly. They need more time to digest this, and I would not be surprised to see some hedge funds implode, some small broker-dealers who play in this space be undercapitalized and wiped out.
What's the moral of the story, though? I mean, for me, I don't play the FX market. I tried it once 20 years ago. It was just frightening. I mean, it's tough for the average person. And then they get this leverage. Some of these companies give them 50-to-1 leverage.
Leverage is like alcohol. It makes good times better and bad times worse. The FX has tremendous leverage built into it, and that's why you're seeing the carnage coming out of this thing.
All right, listen.